Hey, good afternoon, everyone. This is Mark from Right Line Trading. Thanks so much for giving me your time this afternoon. I'm going to be introducing you to an indicator that we just developed here at Right Line Trading. It's probably something that you've never seen before, and I think that when you see how it works and how much predictive value it has, I think you're going to be as excited about it as I am. It's probably something that few of you, if any, have come in contact with. Just a little bit about myself. Now, it's a really easy indicator to understand, and we're just gonna go through the motions of taking a look and see, again, and see how much predictive power it has. Now, just a little bit about me. I'm a graduate of the University of Pennsylvania, former professor at Jefferson University in Philadelphia. I've been involved in the financial markets for over 20 years. I've been trading futures and forex markets about 10 years ago. And what we do here is we optimize software via mathematical modeling. And mathematical modeling is what I did in graduate school. At that time, I worked with the U.S. Navy in optimizing underwater decompression schedules. It was extremely dangerous to do a deep dive, underwater physiology, that type of medicine was really never optimized, and divers, when they came up from real deep dives, 1,000 feet, they would very commonly get the bends. And using a software program called ASOP, or Automated Engineering and Scientific Optimization Program, I was able to look at that closed model and optimize underwater decompression schedules. What we do now is we look at each financial market as a closed system, and we look to optimize the future direction of price in the same way that we optimized underwater decompression schedules. Now, one of the most important thing is defining what independent variables are responsible for making price move out for the direction that price moves out into the future. What is the problem with current technical analysis? And the problem is so huge. It would take me 2 days to tell you. First of all, but 95%, as you know, of day traders fail. And everybody out there advertises they have the answer. You see these gurus that I have them on my Facebook feed. But in point of fact, it is very, very difficult to be consistently profitable. Now, this is unacceptable in any other field of human endeavor. And the problem is that this number fails to improve over time. 20 years ago, 95% of day traders were failing. Today, 95% of day traders are failing. So whatever the problem is, we have not found a way to learn from the mistakes of the prior generation, which has busted out of the market. Like, over time, we don't modify the principles by which we trade in order to determine what works and what doesn't work. And that's because the gurus that sell software and teach you trading methodologies, the whole system never changes. If you look at what they were teaching 20 years ago, it's the same thing that they're teaching today. You look at the indicators that they're proffering to you, they're the same indicators that they're proffering to us today. Nothing ever changes. So, as I said, each generation of day trader fails to learn from the previous generation. If this was true in medicine, if this was true in architecture, where 95% of architects put up a building and it fell down, 95% of patients that you treated as a doctor died, it would be I mean, it just would not be tolerated. And what these other two fields of endeavor do is that through rigorous scientific testing, you tease out which elements of what you do work, which elements of what you do fail, and slowly over time, the success rate begins to improve. But for some reason, it doesn't happen here. And that's because day traders, for the most part, accept current dogma without mathematical verification. How many years? Has it been 25 years that traders have been trading Fibonacci? Has anyone ever asked what is the sensitivity, specificity, positive predictive value, precision of using Fibonacci to trade? If they did, they would never use it, because the thought that this kind of math, which was developed in the 18th century, I believe, might have been the 16th century. Yeah, I don't remember exactly. Hundreds of years before the markets were invented, would somehow predict how price is going to move out into the future in this closed system is absolutely, it's just staggering. I mean, these are the kind of things that traders use and they don't work. And this is why at Rightline, we've kind of thrown all that out the window, and looked only to use what works and discard what doesn't. And if you do a Nexus Lexus search of the world literature, you will find that there's hardly any articles in the world literature regarding rigorous scientific testing of different indicators, looking at whether or not they actually help you determine where price is going to move out into the future. And that's because for some reason, scientists fail to take this kind of trading seriously. There doesn't seem to be a department in any university that looks at the art of day trading or swing trading to provide us with specific information as to how to trade, and for us to read this body information and to get better and better at it. We're all still really at the point where we were 20 years ago, and really not that much has changed. Now, a few things have changed, and I don't want to drone on too much, but the fact is that now institutional trading and algorithmic trading and computer-generated trading is much, much more prevalent. When I first started 15 years ago, actually in 2004, it was just not like that. It was much easier to trade. Reading price action and market structure, like understanding Japanese candlestick patterns, was much, much more powerful, because the movement of the market was not so tremendously dependent on the huge money that just clicks in, apparently for no apparent reason, and when the institutional traders start grinding the market down or up. So the environment with which we day trade has become much, much more challenging, because we have to deal with that variable that's almost impossible to predict. So this indicator is really part of that new paradigm of a really, really powerful way of determining how price is going to move out into the future. Now, this is called the cash internals indicator. What we do, now these are some of the tickers that we use. We use 16 tickers, 4 groups of 4 tickers. Now, there's 4 tickers on the Dow, there's 4 tickers on the NASDAQ, 4 on the S&P 500, and 4 on the Russell. Now, you're going to need a new data feed for this, and there's no way around it, and I'll talk to you about that in a second. Now, no one's ever done this before that I know of, and I'm going to show you on a live chart how incredibly helpful it is to use. Now, what the cash metrics indicator does. Now, I took this out. I don't know how it got back in here, but it looks at the ratio. Now, remember, if you're trading futures, you are looking at an analysis of the cash market. I mean, the direction of the cash market correlates very highly with the direction of the futures market. So, and to understand what's going on in the cash markets, remember you have a cash analog. If you trade the E-mini futures, you have the S&P 500. You have the Dow, you have the Dow cash. If you have the Russell futures, you have the Russell 2000 index cash. And the same thing with the NASDAQ. You have the NASDAQ 100. So what we do is we look at the ratio of up volume to down volume, the ratio of advancing issues over declining issues, the ratio of stocks upticking versus stocks downticking. We'll look at these three parameters. Now, forget the ETFs because we've removed that. And this line is a little bit more progressive and formatted better than the one that we had previously. Now, when we first developed it, we had two lines. Now, a lot of the slides that I'm going to show you have two, and then towards the end, it's going to switch to one, because we were able to merge them. And what we did was we put all of the tick data in the upper line. So the ratio of stocks upticking to stocks downticking is in the upper line. Volume is here. The ratio of up volume to down volume is here. Now the tick data for some reason comes in faster. The volume data comes in slower. And all of the data breaks down into these market internals, exactly what's going on in the cash markets while you're trading the futures markets. It also helps you immensely if you're day trading stocks. Now, if you're day trading a stock with tremendous relative strength, it still has its greatest potential to fall when the cash internals are negative. And it's going to have its greatest propensity to rise when the cash internals are positive. It's just going to rise more when the internals are positive, and it's going to fall less when the cash internals are negative. But it's still going to be moved by this cash internal assessment. And I'm going to show you that. So we're actually looking at the cash markets to help guide us as to how to trade the futures markets, or we're using the data to help us trade stocks. Either way, it's of tremendous benefit. Now, I'm going to go right to examples, because this is a very, very simple indicator to understand. It's not so easy to program, but it's simple to use and simple to grasp. Now, I did all kinds of different time frames, and this is, again, is before we switched it to one line. So in this particular case, we would have the top line being the ratio of stocks upticking to downticking, the stocks advancing over stocks declining. Down would be the same, and this would be volume. The stocks, the ratio of up volume to down volume. And when both lines are green, this is Garmin. This is all the way back from 2017. Nothing is going to change though. Garmin is going to rise no matter what the time frame is that you look at. And here's the Kami. This is the same thing. Like I said, this is not a hard indicator to use. When both lines are red, Garmin is very, very likely to fall. This is a $1.50 move. I don't remember what economy is trading for right now, but you can go for a big move with a very small risk to reward if you stay in the direction of the cash internals on stocks. Now here is Nvidia. The profit's $1.08 and the risk is only 10 cents. This is an 8-range candle. And as long as you've got dual reds, you can hold this short for the entire period of time. Now, you're not always going to see dual reds for this extended period of time. But when you do, price is going to follow. Because market internals, you have more stocks moving on down volume. You have more stocks moving on the down tick. And you have the advanced decline line heading to the downside. So everything is pulling this stock to the downside. Now this is Best Buy. And what you can see here is that a lot of traders or a lot of software vendors tell you how to trade gaps. Now a gap is, let me tell you why 90% of the information that you learn about a gap is absolutely false. Now you may have heard lectures on the subject, and in which pre-market you evaluate the gap, and that information is going to tell you how to trade it. Well, that's absolutely impossible because pre-market, the gap is created by small commercial traders. And the way the stock gaps pre-market is going to have no effect on how the stock gaps once the market opens. Because it's only when the market opens that the big institutional traders come in with their big money and they start working that gap. And whether the stock is going to gap to the upside and run to the upside, or it's going to gap and craps, as they say. It gaps up on the small commercial traders' dime, and then the institutional traders just ram it down. But if you look at the cash internals at the market open, you're going to get a great idea of how this stock is going to run. Now, the cash internals may not be aligned, in which case you can't know for sure how the stock is going to gap right at the open. You may have to wait a minute, you may have to wait 2 minutes, but if you see a gap, this is going to give you a great idea of which way that the gap is going to go. Now, right at the open, this can really fluctuate a lot. Because remember, there's always there's usually an imbalance created pre-market by the small traders who create a buy-sell imbalance. And if you follow some of the data feeds, when this buy-sell imbalance is very large, they'll actually publish it for you pre-market and tell you that there are 4 or 5 stocks that are sitting to open with enormous buy-sell imbalances. Now I use Benzinga Pro as my data feed provider, and maybe 2 or 3 times a week, they're going to come out with the buy-sell imbalance on a particular stock. If it happens to be a stock that's gapped, that's also going to provide you with great information. That probably, if there's a tremendous number of buy orders waiting to get filled when the market opens, this is going to rotate the green. And you're going to catch this move to the upside. It's a leading indicator. And what makes it completely independent of what you're trading is it's analyzing totally different parameters. Again, advanced decline line, up tick, down tick, up volume, down volume. Now here's Opco Kinetics. You can see it gapped up, and then once the market opened, it gapped back down. Gapped down, and then rolled to the downside. So you have the gap up, Market opened, fell right to the downside, and then rolled to the downside. So you can be very, very deceived by how a stock behaves pre-market to how it behaves post-market, because it's moving on collectively a completely different set of traders. Pre-market, the small commercial traders, market opens on big institutional volume. If they trade it, they may not, but usually they're interested in trading a gap. Here is Console Energy. I believe that's the ticker, and it's $1.10 on a $15.90 stock. I mean, that is a swing trade. It's not a day trade. So if you want to take a longer term time frame and hold it over 2 or 3 days, as long as you've got this in your direction, you can look for a really, really nice move. Now I'm going to show you a lot of futures markets in a second, but I just wanted to show you individual stocks first. Here's Facebook, and here's the market open, and you can see what happened. I mean, there really, really wasn't much of a gap, but as soon as the market opened and the cash internals went negative, Facebook just crashed. Now, Facebook did not crash. Facebook's crashing didn't turn this line red. This line red is pulling Facebook down, because this is not just looking at Facebook. It's looking at all the stocks in the NASDAQ 100. So it's not just doing an assessment of what traders are doing with Facebook. It's looking at an assessment of what they're doing with all 100 stocks on the NASDAQ 100. And then on this day, at the open, you've got this huge gap up. And the question is whether it's going to gap and run or gap and crap. And here it just gaps up and then continues to run to the upside. So it tells you exactly what to do right after the market opens. You don't get caught with your pants down in the wrong direction. Now here's 9 points on the NQ. Now you're looking at the futures market, and I did a lot of different time frames because the time frames are irrelevant. This is a 3-minute of the NQ futures market. And you can see that here's an entry signal, and boom, it's right off resistance. You don't need this entry. And down you go for 9 points on the NQ. Now, it's compatible with this. I don't like to say it should be a standalone indicator. You have to have some system that you use that you're trying to make work. But this is going to add a tremendous amount of predictive value, i.e., it's going to validate your trade entry so that when you see it right here, like this triangle is a consolidation signal. And when you get that break of consolidation and the cash internals are negative, this is going to fall, almost always. Here is the E-mini, and you can see it goes up, comes back to support, and what happens when it hits support? Up it goes. So you're not just going to move in willy-nilly, because this is giving you an absolute direction to trade. You, via your system, via your signals, have to look for your long entry and then validate it with the color of the cash internal line. Now here's the E-mini, and you can see the E-mini at market open is green, right after the market opens, and boom, you get 7.25 points. Now it flattens out. And remember, the upper line is going to be the tick data. The lower line is the volume data. Now, what we've done to make it simpler is you can see that now we merge this into one line. And one line gives us all the information we need to trade the market. But right now with them split, you can see you still have volume data. You don't have tick data. But the most predictive line, and I can't tell you why this is is the volume data. It's slower, and it seems to predict the direction of price a little bit better than the tick data. And I cannot tell you why. It's just an empirical observation from watching this indicator work for quite some time now. Now here is Walmart. And you can see right at market open, you have to wait till the market opens. You've got your move to the downside. Even when price takes a move up, it's eventually going to roll if these lines stay red. Now, it takes a lot of guts to move to hold this through this big retracement up. And you're probably going to want to take your profit on a reversal candle, however you feel it's best to do. And then you can go short again, say when you get this C candle entry. But you have to stay in the direction of the cash internals when you trade stocks, and they're going to follow. I mean, they can't help it. Even if they have tremendous relative strength, amazingly good news has come out on Walmart. It is going to fall less, but it's still going to retrace or pull back to some degree when the cash metrics are negative. And here is Lennar. There's a signal out of consolidation. You've got the cash metrics, and you've got a perfect short. And here's your perfect long and up. Now it gets redundant, and here's Tesla, right up. And here's Tesla again, as trading a gap. Now here's 930. Now every now and then, the cash metric indicator is not going to start creating data until a minute or two pass, because the data just starts to get generated at market open, and sometimes it just, for electronic reasons, doesn't give you a line of any color. It just stays yellow, yellow, and then bam, it'll kick in like this. And when Tesla is above the 50, above the 15, and you got dual greens, you're going to go long. And that's an $8.46 move. It's not a huge percentage move, but it's a great day trade if you can own enough shares of Tesla. Now, this is a little bit more complicated. I'm going to go through these. I'm just going to roll past these. These are all using the cash metric line. Now, here's a slide I just made. Now we've got one line, and it's encompassing all of the different metrics. So it makes it very, very easy to use. Now here's the NQ, and you can see now the chart. This is September 4, 2018. You want to trade the NASDAQ when this line is red. You're never going to take a counter trend trade. The trigger is going to be based upon whatever your entry signal happens to be. You're not going to take this long retracement, because it's the one thing that you don't want to do is get into moves that are high risk. And the futures market is not going to move always in tandem with the cash market. It's got some play, which is why you need to optimize your entry. But here, all it does is come up to resistance, hit, and roll right back to the downside. You're always going to stay. This is a failed up candle, failed up move, failed up move. This moves up nicely. It just rolls back to the downside. That's the direction you're always going to stay as long as this line is red. And you can see for a brief second, it turned green, but it was of no relevance. Now here's another trade on the NQ, and you can see it's chopping in here. The line is red, yellow, red. You really don't have a great short trade. If you went in here, this would give you a small short trade. This really isn't going anywhere. What you need to do is to set your stop behind resistance, so you're not going to get knocked out of the trade. Use the trigger, but you know the only way that you can trade the NQ is to the downside. There is no other direction to trade. and it's gonna fall. Here again is another NQ. Kind of picked on it, but I'm going to show you the Dow. I'm going to show you all the markets. Now here's Amazon. And you can see, even though it's going green, yellow, it may not stay totally green, but you never see any red. So there's always a predominance, an overwhelming predominance of up volume to down volume, up ticking to down ticking on the NASDAQ. And the advanced decline line is always rising. And it's going to take Amazon with it. And again, even if really terrible news came out on Amazon that was pummeling it, number one, you'd be obviously a lot more careful taking along. But number two, it's still going to rise some when the cash internals are green. It may not rise as much as it would as if there wasn't a lot of bad news weighted into the price of the stock that day. But if you're going to trade it, this is the only direction you can. Here's Apple Computer, same thing. And here's your perfect entry on Apple right here. Once it breaks the 50, you wait for the retracement back up. The cash quants are red. The cash internals are telling you what's going on inside the NASDAQ, and down you go. And that's a very, very nice trade on Apple. And that's a big day trade. It's a lot of money. Now, I'm going to go through these faster. So I don't really want to go into because I put, for some reason, I put two indicators here. So really, we're coming to the conclusion that I'm going to show you a live market. That's where the pedal hits the metal. For trend trades, the indicator is superlative. When you get an entry on a trend trade and you're trading in the direction of the cash internals, it's going to help you immensely. It's going to help you trade gaps because you're going to know whether a stock's going to gap and run or gap and reverse. It's going to help you trade the market open. Although I think trading the market open is a little bit dangerous because all of those pre-market orders have to equilibrate, and I always stand aside for a few minutes. If you're hell bent on trading it, this is going to give you a leg up on it. And for sure, if you want to trade a reversal, if you want to try to call a top or call a bottom, I think that's one of the most difficult things to do in trading. But what this gives you is at least a window inside the market that you're trading. If you're looking to reverse a stock, you're going to wait till its respective index, the internals on that index have reversed. If you're going to trade the futures market, you're going to wait till the cash internals of its respective market has also reversed. So it's going to give you the best opportunity to get in at the beginning by trading a reversal. Or like I said, the reversals I think are dangerous. They really are. All you got to do is be overrun by a candle or two and get taken out, and then it's going to roll to the bottom. And I've tried all kinds of things to try to pinpoint the reversals. It's better now, but in general, I just don't. That's just me. I would tend to stand down on them when we can get such great trend trades with this analysis. There's no reason to risk any money on the open, even on gaps, and definitely on reversals. I just love the trend trades. But you have the opportunity to optimize or increase the predictive value of taking a trade on any setup. Now, let me show. I'll show you our offer second. Let me first show you a chart, and I'll show you all kinds of stuff here because I think that's the most important is to see how the index works. remembering that right now when we're looking at Apple today, we're using a uni-renko chart. And I don't really want to go into uni-renko trading because what I'm profiling here is the cash metric indicator. And you can see it's called the cash metric internal NASDAQ. So we're going to look to trade the Apple computer when the NASDAQ internals, they're going to point us in the direction. Now I'm just going to give you a little bit of information about how I trade. And this is just how I trade it. When the stock is below the 50, which is this, I always go short. When the stock is above the 50, I look to go long. So with a pivot, I look to see, I want to take the short trade here. And what I'm going to do is I'm going to look at the cash internal. It's red, and I'm going to take the pivot down. I'm not going to take the counter trend trade. I'm simply going to look right here on this wick. I have the move to the downside, and I'm not going to take the counter trend trade. And right here, we're real close. We may not have it red. If we don't, we have no entry. We're not always going to get an entry on every move to the downside, but this is leading this. And we're looking for it to turn red and for price to roll. We can go through the whole day and you're going to see how well it correlates in direction. And let's go right to the open really quick. And I'll do any stock you like that I can put a ticker in for. I can put in 500 tickers right here. Now that's just doesn't make it. You're not always going to get a perfect setup here. So it's hard to get in right at the down pivot, but you're close and you just don't have a perfect entry here. And you will not always get one, but here you do. And as soon as you break the 50, you're looking for a pullback and continuation long. Problem right here is you just don't get one, but you can see the absolute direction that you must trade. Remember I told you about trading a reversal? There's a reversal. Now I don't like to trade short above the 50, but if you're going to do it, this is when you're going to try. Here, when you try it, you're going to do it on a yellow. Here, you don't have a red. Here, you don't have a red. And here's your big moves. They're all telegraphed to you. The roll down. This one's not quite called. You have to wait till you get this pullback right here on this wick and the move down. But you can see it's telling you right from here through to here, you just can't take Apple Computer long. You have to take it short. What you need is an optimum entry. So this isn't an indicator that gives you a precision entry. It's an indicator that gives you a precision direction to trade. And let me tell you that's 90% of the battle. Right here on this break of the 50, right, you go right down. And this is right at market open today. Now let's look at the NQ. And then we can look at the E-mini. You look at anything. Now remember, there's one line for the NASDAQ, one for the Dow, one for the Russell, and one for the E-mini S&P 500. So let me look at the NQ. Now here's the futures. Here we go. Now, there's no way that this line should be green all this way. Well, let me try to reload the chart. Hang on a second. Hold on. There we go. I don't know why this is doing this. Hang on a second. Let me just check the data feed here. Make sure I have that. I'm sure it's connected, but let me make sure. Yeah, my data feed is connected, and I don't know why I'm getting this solid green line. Go all the way back here. We don't have our tech guy here. I mean, obviously, in this webinar, it's not a great time for this to go solid green. And I can't tell you. Now, here it stops. And I don't know why we've got it solid green. Let me keep going back. And I can't tell you why it's doing it. I'm sorry. I cannot tell you. Let me just reload all historical data. Let it load. It's waiting, Seth. It's waiting. All right, here we go. Now, the next step forward is there's actually a cash equivalent of the DAX. Now, I don't see it's changed that much. And I can't tell you why it's locked like this. I really don't know. I'd have to get Sergio to check, and Sergio left 42 minutes ago. I can't tell you, I'm sorry. The chart still hasn't released. Hang on a second. It's nice when you're demonstrating it and it fails, but I'm going to put in a different cash metric line. Let me see if that's going to work for us. Maybe because the market is closed. I don't know. Wait a second. Of course, I'm getting the wheel of death here. Hang on a minute. All right, it just unlocked. Let me take a look. No. It's something with my Ninja Trader. Because I want to show you the E-mini and I want to show you the Dow. All right, it's unlocked, but for some reason it is not working. I don't know why, but here's what I'm going to do. Here's the indicator. It's right here. It's the RL Uni Cash NASDAQ. We're going to remove it. And we're going to go to the RL Uni. We're going to go to the cash S&P 500. We're going to load it. I don't know why something's going on. Let me look at the E-mini. Let me change markets. I can't tell you why this is. I really apologize. Obviously, I'm sure that it has you enthused when the indicator is not tracing out accurately. I have no clue why. Now, if Sergio was here, he could fix it in a second, but for some reason, it's just going green. Okay, now we got it back. Now, I don't know why it did that. Now we're looking at the S&P internals, and we're looking at the E-mini markets, and it's working perfectly. Now, here is the market at open. Here's 9:30, right in here. Now, you can see right here, E-mini internals or the S&P 500 internals call this short trade right there. Now, I'm not going to take the counter trend trade. And that's all there was today on the 4 uni-renko. I mean, that's all the volatility that there was right here. It was one trade, and this was the short trade. So it was a terrific entry and big move. Now, let's take a look at the Dow. We can look at the Dow stock as well. You can pick any stock off the Dow. Now, obviously, the Dow is the toughest because there's only 30 stocks on the Dow. And so the cash metrics, you know, and the Dow is market cap weighted, it's a little tougher. But I want to mention one other thing. Okay, here we go. Now, for some reason, I'm getting two lines here on the Dow cash. Let me go to the Dow and the YM. Sorry about that. I apologize. So if we had our tech people, I had my tech person here, it'd be functioning fine. Now remember, we moved the two lines to one, and the predictive value that we're looking for is now we're looking for both lines to be together. And so I can't tell you what the analysis is, but you're going to get a long trade here. Now it's just splitting the volume data and the tick data. And the volume data outweighs the tick data. So this is going to give you a Dow long trade. This is going to give you, got to wait, but it's giving you the direction to the short side. And then here you can see you don't have much of anything, but being below the 50, you're going to look for this thing to roll. And you really don't get dual reds until much later on down here. You don't have much of anything here. And here's your upper green line. I wish this was functioning on one line. So you have one perfect trade on the Dow, which was right here. Now let's go back and go back to the NQ real quickly. I want to show you the QQQ, which is a really excellent instrument to trade using the quants. I'm really sorry that they're not working perfectly. It's always going to be in front of 100 people in a webinar when it does it. I just have to change the indicator and go back to the cash NASDAQ. And maybe by putting it in, it'll function now. And here it's working terrific. Now, if you want to trade the Qs, they trade great. Here's your short. Let's go back to the beginning. Right here's the open. You don't really have an entry. Goes long. Now there's your short entry right there on the break and the move down. And you can see it reversed right here. It went green. Now I think that's a risky trade. It's a counter trend trade, but it's called. Now you don't really have a solid direction to trade. You don't have an entry. And there's your short entry. This is why you need an entry trigger that's going to go in the direction that the NQ cash internals are going to give you. And you get this huge move to the downside. Now you're way oversold here. Now what's going to happen when the NQ hits here, hits the 50? Not clear, because this line is yellow. Still hasn't rolled. So, but on this wick, it allows you the entry short. Don't have it red. Here it's where it's red. And here's your great move to the downside. Now, you're not going to get every single trade. If the indicator called every trade, we wouldn't sell it. But it's going to give you a great idea of when to get in. This is a very small trade. We didn't have it turn red. Those cash internals turn. There's no trade. I'm not going to counter trend. And here's where it calls that move to the downside perfectly. Here it's calling this move to the downside perfectly. It's not a big move. It's a small, small move. Now, here you're way off the 50 and you don't have a trigger. Here's your trigger. And I don't really want to go into trading technique or trading style here. I just want to show you that here's your retracement and here's your roll to the downside, and it's giving you a great direction and has tremendous predictive power in telling you by looking at what's going on inside the NASDAQ, the Qs are great to trade. And right here is your perfect long. You're above support and up you go. So I hope you see how helpful it is. It's really, really a terrific indicator. It's really an indicator system, and it's complex. I'm not going to kid you by telling you it's simple. We're going to have to format it for you, and we will. We're going to do all of the tech support on it because now I want to go over the data feed. I want you to know what the requirements are, so you're not surprised by anything. Now let me move the slides back, and let me go back in here and show you the slideshow from the beginning. Just gonna have to rotate this, and let's go to the end. Oops. Now, if you want one market, it's $199. So you can pick what market you want. If you just trade NASDAQ stocks or just NASDAQ futures, you only need one market. If you want two, it's $349. If you want three, it's $475, and it's $575 normally. But if you buy three at $475, we're going to give you the fourth market for free. So basically, it's four markets for $475, or you're going to pay individual, $199 for one, $349 for two, and it's really $475 for four markets. Now, if you like the indicator and you want to purchase it, when you email us back the information, when you tell us your NinjaTrader customer ID number, you're going to have to tell, if you're trading only one or two markets, you're going to have to tell us which markets you want the indicator on. Now, for the first 10 orders, we're going to put you in the trading room with me, and you're going to see how well this works trading the futures. Today, in about 40 minutes, we were up about $475 in dollars. We had a $350 trade on the DAX. That was the if you convert that to euro from euros to dollars, that was about a $410 trade. And then we had a smaller trade on the NASDAQ for 60, which I only traded with two contracts. So just under $500 for the day on two trades and out. So it makes trading a lot easier. Now let me go through and answer any questions that you have about it. So I'm just sure that it's clear to all of you. So hang on one sec. Let me pull the questions. Okay, I got them. Okay, so hang on here. I knew somebody would may say something about fibs, but that's okay. Okay. Hold on a sec here. Okay. Okay, I'm sorry. All right, fibs are made for painters of portlets centuries ago. They had to calculate several properties of the fibs are not for trading. That's my belief. Wow, that's exactly what my belief is. We've done an analysis of Fibonacci retracements. We have in no way found them to predict where price is going to move out into the future. That is determined solely by institutional money. The price is going to continue to rise as long as institutional traders continue to pour money into the market or continue to take money out. Fibs break, sometimes they hold. When you have an indicator like that, it's useless. And so I would never trade off of fib support or Fibonacci resistance. In fact, I could go back. I could show you how when you get traders caught in the counter trend direction, trading off of Fibonacci, trading off of oscillator divergence or MACD divergence or Fibonacci, and the market goes 2 or 3 candles counter trend, you actually hope it goes that way. Because then when it moves back into the trend direction, in the direction of the cash internals, it's going to help push the market down because they're going to get run over and stopped out. And it's going to push the market right in the direction you want it to. So we would never trade fibs. And it's a big canard. And fibs have been around for 20 years robbing people of money. And I call them vendors who continually don't trade the market live and who just want to make money continually to push them on you. I mean, they don't stand down and say, you know what, they've been around for 20 years and I don't know of a successful trader. They just keep on doing it. And they're going to do it forever. Doesn't make any difference. Yeah, I know. Oh, he does, John? Okay. I didn't know that, John. Pizzazz. If he does, all the more power to him. My hat's off to him, really. Remember, Fitzroy, this is for stocks and futures. On the NQ cash metrics, you can use it to determine the direction of the futures market, which is determined in part by the direction of the overall index. Just like the direction of a NASDAQ stock is determined by the direction of the overall index. You're going to put it right on the uni-renko chart. Okay, hang on a second. Yes, it does, Ford. It increases the predictive value of all the indicators that we have. And we have a pretty sophisticated system. And the one thing that we don't do is pop an additional indicator in unless it increases the precision of our trading. And we have, I don't know, we probably have 50 that we developed and then we throw away. They look like they have tremendous value, and then it's determined that they're a dependent variable, and they're dependent on some other indicator that's already present in the platform. But this is running off the cash metric line. If you're trading futures, you can see it's completely independent, and it's going to move on its own irrespective of the direction of futures. And if you're trading one NASDAQ or one E-mini or one Dow stock, it's also going to move completely independently of, it's going to move dependent on the line, independent of anything else that you have. It makes a big difference. And it's going to keep you out of trading in the wrong direction. Right, the SPY, Hardy, I didn't have a chance to put it up, but the E-mini line is really excellent. I'm telling you, it's going to help you tremendously trading the E-mini or trading anything on the S&P 500. It's really, really a value. And the S&P 500 and the NASDAQ are extremely powerful. The Russell too, because the Russell is working off of 2,000 stocks, S&P off of 500, the NASDAQ off the NASDAQ 100. The Dow's is a little less powerful because it's 30 stocks and they're market cap weighted. And I just wanted to say just one other thing, and I don't want to confuse you. The important thing to remember, and this is one of the things that we had to overcome, was that if you use the advanced decline line, without looking at up-down volume, you can get into big trouble. And let me tell you why. The NASDAQ is market cap weighted. So let's say that there's more stocks advancing on the NASDAQ than declining. But what's declining are all the big caps. Google's falling, Facebook is falling, Amazon is falling, Netflix is falling. All those big cap stocks are falling. Well, that NASDAQ 100 is going to be weighed down by the volume and the ticks of those particular stocks. So the advanced decline line is going to get skewed. So overall, you can have advancing issues on the NASDAQ, but you're going to have the NASDAQ fall because the advanced decline line is going to mislead you. You're going to have more advancing issues on the NASDAQ, but it's going to fall because the big caps are going to weight it. And the way we overcome that is by looking at up volume to down volume and up ticking to down ticking. There's no market cap weight. Every stock is treated the same. It doesn't matter whether it's Google up ticking versus down ticking, Amazon up ticking versus down ticking. The up tick, down tick, up volume, down volume line overcomes that issue with just looking at the ARMS index, which is the advanced decline line. And that line can really mislead you. So that's what you have to be careful with. And that's what makes the analysis a lot more sophisticated than you might normally think, or off of another indicator system. I use this, Robert, I use this in the room for futures. I used this on the NASDAQ this morning, and it really helped us out. The NASDAQ had some great trades. I just couldn't get an entry. I finally got one, and I got a winner. If you trade and use this line, it's going to be of tremendous value to you. And you know, really, the NASDAQ the room was only open. We only traded for about 35 or 40 minutes, and that whole time, that line was red, pretty much the whole time. And then it started to rise and fall and get choppy. We were out and gone. Okay, yeah, I will. Just wait 1 second, louder. No, well, I can show it to you. I just don't want to, I don't want to, it's not a problem. Let me show it to you. Hang on 1 second. Let me put it in. Because I know a lot of people trade the E-mini. And let me put in the S&P and get the assessment. Now here it is. Oh, actually I did show it. We'll go back a few days. More than 1 day. Let's go back the day before. Now here's the E-mini. Right here. Now here's the open. You can see you don't have, sometimes you don't get data immediately. Now right here, you don't have the line. It's just a candle away. But what I like to do is take my entries on the second candle of the pivot. I did it in the room today on all the trades. There's your short trade right there and down. Now here I'm oversold. I'm not going to take anything. I don't have a signal here, and I'm not taking this shorter. I have nothing here. Here is right where I'm going to take this shorter. Here is right where I'm going to take this shorter. Now remember, the color of this line is totally, oh geez, you know, I'm looking at the cues. What a dummy. Excuse me. Here we go. And let me go back a few days. Let me just load more data, and you can take a look. Now I loaded 15 days, we'll load 25. Remember, there hasn't been a whole lot of volatility on the NASDAQ. Oh, and here's another thing which I'm going to change, which are going to give us better entries on the E-mini. The E-mini is a slow market, and we're trading a very, very slow uni-renko setting. So we're just going to speed it up a little bit to a 5-2-10, although it does work on any time frame. And you don't have to trade uni-renko. It's not set up for uni-renko. It's set up for any time frame. Let's load the data. Now here we go. Let me slide it over. And we'll slide it over to here. Well, here's the open right here. And there's your roll. And look at the market right here. And this is the quant E-mini, the cash internal right here. You get this whole, all it does is verify that this is going to be a low risk trade. The E-mini S&P 500 internals are pointed down, and down you go. You can't take it shorter here or shorter here because you're way oversold. Now it calls this little move up, and if you're going to take this pivot right here, you've got the move down. All you want to do is look at the color of this indicator at entry. It may go to yellow for a little bit of time. As long as it doesn't turn green, you're in the trade. You have no move up here, and here's where you can take your long trade, right here. Nothing here. There's nothing to trade. Now here is where you got your long move. Now, this may have taken you out on this down candle, but you're going to have to go right back in and go up. And honestly, I could do this forever. These markets are always going to move in the direction of the cash internals. They have to. I mean, if the cash S&P 500 is being driven down on volume and tick data and the advanced decline line in total, the futures are going to follow. Now the thing is that the correlation is not locked. It's not lockstep, which is why sometimes you don't get an entry on a pivot. But it sure is close, and it's really going to be of benefit. So there's the E-mini. So let me just put the slide back up if I can find it. Here it is. I think it's a tremendous benefit on the NASDAQ and the E-mini. And if you trade the Russell, it's tremendous benefit on the Russell. Now, I don't have a data feed connected right now for the RTY, but it really works great on the RTY as well. Dow too, but it's only 30 stocks. Yeah, I did, Stephen. It worked. I know I got it. I got it, Laura. Thank you. Right, S&P, ES, and Q. For uni-renko, Gail, means that every time the market moves 4 ticks in the direction of the trade, you get a new uni-renko bar. That's the offset value. So this is a 2 uni-renko. So every time the market goes 2 ticks, and then it jumps, it's gonna start to form a new candle. So that's just the offset. I can give a whole lecture on how uni-renkos work, but the tick trend is 2. So in a trending market, you're always going to get a new candle every 2 ticks. And that's what that uni-renko makes. And I love uni-renko because they give you the ability to form wicks. Wicks give you a great indication. Like this is, I don't want to get, I always do this, but this is a dual bear failure. Both these wicks. Bears tried to push this market through the 50 twice. They failed. You don't have the cash quant line, so it's riskier. But there's your entry on that second failure. These two wicks in a row. That's what uni-renkos give you the ability to do. Trade patterns like that are very helpful to trade. Now, if you even just by one line, you're still going to be in the room for a month, and you can watch me trade, and you'll see how we do that, Gail. I was looking at the 10.52 Gord for the E-mini. We trade a little bit of a faster E-mini, but it's irrelevant. What I wanted to simply show was the really superlative correlation between the cash metric assessment and the direction of the E-mini futures. That's all. Yes, Pizzazz, you can use the metrics on any instrument. I mean, if you buy all 4 lines, there's nothing that you can't use it on. I mean, a stock is going to fit into one of those categories. Now, you're going to have stocks that fit into 2. Like I believe Microsoft is on the Dow, and it's also on the NASDAQ. But obviously, the NASDAQ is the one you want to watch. It really is, you know, only every now and then is it going to become, are you going to have that little bit of an overlap? But you're going to go for the NASDAQ when you're on the, and you're going to have some stocks that are on the Russell, and they're also on the S&P 500. You're going to trade the S&P 500 because it's got so much more volume. So if it's nebulous, you're just going to stay with the market that has the most volume and the most power. And right now, the RTY or the Russell doesn't have a whole lot of volume. And I used to love the index, but it's just not, it doesn't have that kind of volume. Okay, no problem. I don't mind, Donald. No, remember, Donald, it can't work on Forex because there's no Forex cash equivalent. Like we can't have it on gold, we can't have it on crude, because those are pure futures markets. And what we're looking at is to get the internals off the cash equivalent. Now, somebody in the room in the trade room this morning reminded me that the DAX trades off a cash equivalent. It's 30 stocks that trade off of the German stock exchange. So we're gonna move this to the DAX, and we had a huge winner today on the DAX, which I love to trade. But we can't have a Forex market because there's no cash equivalent for it. So in that regard, it's limited. If you're going to be a Forex trader, this is not going to help you. I want to be honest with you. Well, the higher time frame, Steve, we only have one line now. So you're not going to have to worry about it. And you're just going to simply look for the assessment of that single line. When we had the 2 lines, it was tougher. Right, and again, we don't. Remember, Amal, there is no crude gold markets. Yeah, well, yeah, it's always when it can go wrong, it will go wrong. When you're have it in a display, it's gonna stop working. Does it matter if you use a higher time frame? No, it does not, Caesar. This is not a time-dependent indicator. I mean, if it's a true force that moves the market, it is candle type independent and it is time independent. It makes absolutely no difference. And if you remember the JPEGs I showed you trades on Garmin, I showed you trades on Akamai. Some of those trades lasted 2 and 3 days because they were on long minute charts. So you can use this to swing trade or day trade. It is irrelevant how you do that. It's still going to work. This is not time dependent. No, they don't, Larry. The cash internals do not replace the quant lines. A lot of people don't know what the quant lines are, but the quant lines are correlative markets on other futures markets. This is looking at an assessment of the cash markets when we trade the futures market, or the cash internals when we trade stocks. So they are apples and oranges. That's why they add so much power. When the quants and this line align together, you get two independent assessments that are completely divorced from each other, each reaffirming each other to tell you you've got a great trade. The webinar is recorded, Heinz. And now right now it's only NT7. It'll be on NT8 very shortly. Our NT8 platform's rolled out. There's just a couple of things we need to bring up to snuff on it. It's a very complex indicator. All our indicators are not so simple, but it'll be operational on NT8 early next week. This is a one-time purchase, Vincent. One-time at this price, because we really have reduced the price for the webinar. I can't find the slides, but and it's a lifetime. If we make it better, if we improve it, if we have an upgrade or an add-on, people who've been with me trading for 5 years, who bought this software 5 years ago, are now trading the updated version. We never take another dime from you. So, you know, you're going to get this software on a lifetime license. Gene, they're not 24-hour indicators. I don't want to do anything to mislead you. The cash internal data is not transmitted pre-market. Now, I can't tell you why, but I'll show you the data. Here's my Superdome. I'm connected to Kinetic. That's what you're going to have to use. Now, some brokers, we're going to give you the tick information. If your broker offers this tick data, which is right here, see all this? Then you can get it for free. And maybe it's transmitted pre-market, but I have a feeling this is just not given out because volume is so light. You're going to see that line light up right at 9:30, and it's going to go dead right around 4:15, 4:30, and it's just I mean the data just shuts on and off like a light switch, and I think it's primed to do that. So it's only going to be an intraday trading tool, and I don't want you to have different expectations than what we do, than what you're going to get. But you can see this is why I'm going to have Sergio configure everyone, because it's a big pain to configure. And if we gave you a zip file and gave you instructions, it would be a lot of work for you to do. So you don't have to work it. And I'll show you right here. Here's our account performance. Here's our trades. Disappeared. Hold on a minute. Let me see if I can get it back. It's right here. Our summary was 410, but a lot of those were in euros. When you convert the euros to cash, this is about a $470 cash day on 2 trades only. And that's how we did today. Remember again, Larry, no crude. We can't do crude. We have no cash equivalent. So we cannot do it. Okay, the extra data fee requirements, Stephen, are important, and I want to make this clear. Unless your broker provides these indicators, now these don't roll over, there's no contract date, because these are just metrics. They're not futures markets. If they don't provide you with these, you're going to have to buy them. And I'll show you, I have to pay for them. Listen, at $10 a tick, it's going to cost you 3 ticks a month. But you're going to have to go to Kinetic. We'll show you how to do it. We're going to walk you through everything. And you go right here. And you're going to have to, and what you do is you just get the 500, the tick trend plus 500 other market metrics. This is everything that you get. And we're going to pick out the ones that you need from this monster list right here. And that's what you're going to buy. and you're going to hit subscribe, and you're just going to get the basics of it. It's right here. It's $60 per month. You don't need anything more than that. You just need those 500 tickers. That's all. You don't have to add any of this. We'll show you exactly what you do. You don't want any other select exchanges. We're just looking at those 500 metrics. We're not looking to trade, use this to trade any markets. And this is what we do need. So there is an overhead on it. It's the cost of doing business. It's going to cost you $60 a month to run all 4 of them. Unfortunately, if you buy one, it's still going to cost you $60 because you either get all 500 metrics or you get none. So I just want to make that clear too.